All right, let's talk about how the pros really read a market. We're going to go way beyond just looking at simple patterns and dive into the structured, repeatable way that institutional traders see things. Let's get right into it.
You know the feeling, right? You spot the perfect breakout, you jump in, and then bam, it just completely reverses and smacks your stop loss. Or you put your stop in what feels like the most logical spot, only to watch the price dip down, tag you out to the exact penny, and then launch into orbit without you. If any of that sounds familiar, it's probably because you're reading the map. You're just reading it upside down.
And this right here is the fundamental difference. You see, the average trader is trying to predict the future. They're looking at the chart like it's a crystal ball. But a professional? They see it more like a map of probabilities. They're not trying to predict anything, they're preparing. They analyze the market in layers, kind of like peeling an onion, to find these sweet spots where the odds are just stacked in their favor. So let's start peeling back those layers.
Okay, so the very first layer, the outermost one, is the big picture, the macroeconomic environment. We're not talking about the day-to-day news chatter here. We're talking about the huge, powerful currents that control where money flows around the world. This is the why. And this quote just nails it. Think about it. Your trading strategy, your cool chart patterns, all your indicators, that's your boat. And it might be a perfect state-of-the-art boat. But if you're trying to sail north and there's a hurricane-force wind blowing south, well, you're going to have a really bad day. The macro environment sets the main trend. It's the path of least resistance.
So what are these big macro winds we're talking about? Well, think of things like interest rates. They basically act like gravity for asset prices. Or inflation, which forces the big central banks to make moves. Or just the overall economic cycle. Understanding these gives you a huge advantage, a directional bias. It tells you whether, generally speaking, it's a better time to be a buyer or a seller.
Okay, so once we know which way the wind is blowing, or why, we can peel back the next layer to find the where. As in, where are the big, market-moving plays likely to start? Where are the big institutions looking to get involved? And the answer to that question comes down to one single powerful word: liquidity.
Liquidity is literally the fuel that makes the market go. You see, if a huge fund wants to buy, say, $1 billion worth of an asset, they can't just smash the buy button. The price would explode, and they'd get a terrible entry. No, instead, they have to be sneaky. They need to find a giant pool of sellers all clustered together. They need liquidity. And believe me, pros spend almost all their time hunting for it.
So where do they find these pools of orders? Well, just think for a second about where everybody places their stop-loss orders. It's totally predictable, right? They stick them right below a recent low or just above a recent high. And all of those stop orders bunched together create these massive, juicy pools of liquidity.
And this right here, this is the massive mindset shift. Price is drawn to liquidity like a magnet. Those stop orders, the very things that are supposed to protect retail traders, become the fuel that the big institutions need to fill their own giant positions. So the market isn't necessarily going to some random price level. It's going to where the orders are.
All right, so we have our why from the macro weather and our where from the liquidity map. Now we finally get to the last layer, the one everyone wants to know about, the when. This is the specific trigger, the price action, that signals to a pro that it's finally time to pull the trigger.
And here's another huge distinction. A retail trader might see a nice-looking bullish candle pattern and just immediately buy, no matter where it shows up. But a professional? They see that exact same pattern happen at a specific spot they were already watching, a liquidity zone, right after all the stops got taken out, and they see it as a footprint. It's confirmation that the big players have done their business and are now ready to let the price run.
This brings us to probably one of the most powerful concepts in this whole game, the liquidity sweep, or what some people call a stop hunt. This isn't just random market chaos. It's the visible evidence of the big guys engineering liquidity to fill their orders. It's that exact move that makes you feel like the market is personally out to get you.
So let's break it down. Step 1. An obvious FI or low forms, and everybody stacks their stops there. Step 2. Price intentionally pushes just past that level, setting off all those stop orders like dominoes. Step 3. The institutions are waiting on the other side, just quietly absorbing that huge flood of orders. And finally, Step 4. Once they've filled their bags, the price snaps back so fast it leaves all the breakout traders trapped. What looked like a failed breakout was actually a perfectly successful liquidity grab.
So, how do we actually put all this together into something useful? We've got the why, the where, and the when. Stacking these layers on top of each other is exactly how pros go from random guessing to building a complete, high-probability trade idea.
The key word here, and this is really the secret sauce, is confluence. A professional trade is never, ever based on just one single thing. It's about the alignment of several different unrelated factors: the macro trend, the market structure, the liquidity, a specific price trigger, all telling you the exact same story.
And here's what that framework looks like in practice. A pro starts with the why. Is the big picture bullish or bearish? Then they find the where on their chart. Where are those key liquidity pools? After that, they just wait patiently for the when, a very clear entry signal right at that zone. And most importantly, they know exactly where their idea is proven wrong, their exit, before they ever risk a single cent.
Okay, let's make this real with a quick example in gold. Layer 1, the why. The Fed is pausing rates, the dollar is weak, the macro is bullish for gold. Check. Layer 2, the where. We see price pulls back to a major zone where buyers showed up before. We're not buying yet, we're just stocking. And finally, Layer 3, the when. Price dips below that zone, sweeps the liquidity, and then bam, a massive bullish candle forms. That's our trigger. See? All three layers are perfectly aligned.
Now, we've just built the perfect trade setup. But here's the thing. Even with the best analysis in the world, you are still going to have losing trades. And this brings us to the final and honestly, the most important part of the professional puzzle. And it has absolutely nothing to do with being right.
I want you to read that again. Let it really sink in. This is everything. Professionals don't judge a trade based on whether it won or lost. They judge it based on the process. Why? Because they know that over hundreds and hundreds of trades, a good process with a statistical edge will always make money, while a bad process, even if you get lucky a few times, will always fail in the long run.
And the absolute core of that profitable process is just simple math. Specifically, the risk-to-reward ratio. It's just asking one simple question. For every $1 I'm about to risk on this trade, how many dollars do I realistically stand to gain? Professionals are absolutely obsessed with this, and they will only take trades where the potential win is way, way bigger than the potential loss.
Now, this is where things get really mind-blowing. This simple math completely flips everything you think you know about trading on its head. You do not need to be right most of the time to get rich in this business. Just look at that 3-to-1 row. If you only take trades where you can make $3 for every one you risk, you only need to be right 26% of the time to be very profitable. You can be wrong almost 3/4 of the time and still crush it. So if the math is so powerful, why do most people fail? Because of this stuff right here. This is where discipline comes in, and this is where they destroy that beautiful math with emotional mistakes. They turn a small acceptable loss into a massive one by moving their stop. Or they go on tilt and revenge trade after a loss, completely blowing up their account. A pro's risk is calculated, it's consistent, and it's non-negotiable on every single trade. So let's end with this one thought. The goal is not to predict the future. The goal is to stop trying. The real goal is to build a process, a framework that stacks the odds in your favor, and then to manage your risk with cold, unbreakable discipline. That is how you read the market, and that is how you trade, like a pro.